What's going on, folks? In today's video, we're going to be doing a comprehensive fundamental analysis on Google. We're going to look at the numbers of this company, figure out what they're doing right, what they're doing wrong, and by the end of this video, you'll know the intrinsic value of this company, so you'll know if you're getting this company at a good price and if it's trading at a discount. So I haven't covered Google in quite some time, so I'm excited to actually look at this company once again. So what I'm going to do is load it up here in the stock spec software. And if you're new to the channel, this is a software I like to use to quickly screen companies quickly and effectively. And you'll see that in just a moment. We're going to look at three different sections today, folks: the company metrics, the financial valuations, and then lastly, their price analysis. Now, just a quick overview of what these two sections do. They take a look at the company's 5-year history, the trends, compares it to the trailing 12 months, and grades it based off of what positives and negatives. And the price analysis section here is a section of the software where it allows you to put some assumptions in to try to find that intrinsic value based off growth numbers and how many years out you want to forecast the company to perform. And let's say if it's 10 to 20 years, however you want to have it. So with Google, looking at this business right now, on the financial valuations, immediately we're getting a lot of green on the board here. It's getting a score of 9 out of 10. So what does that indicate to us? They're only getting docked a point in the price to earnings ratio for the last 5-year averages, sitting at 24.95. So what that means to us is that on average, you are paying a slight premium for Google based off their earnings and price. Ideally, we want to find companies with a price to earnings ratio of 22.5 and lower. That seems to be a fair multiple as indicated by Benjamin Graham, and I believe that too. Now, covering over to the price to the company metrics category, you can see that the price to earnings ratio for the trailing 12 months is 28.43. So currently, based off the trend that has been occurring over the last 5 years, we are now slightly above that trend. So you are paying a little bit of a premium still for this company if you're going based off this metric alone. Now we can see here on the chart, and I'll zoom this in for you, but we hit a high back in November 2021 of $146. We are almost at those highs once again, sitting at a 52-week high of 138. So Google has had a decent run up starting from late 2022, where it was at pretty much its lowest. I'm going to say, yeah, probably at $83 based off the 52-week range here. And now we've been climbing up. But that doesn't mean that it's out of price for investors that are potentially wanting to get in. Back to the financial evaluations, as we can see here, the 9 out of 10 is obviously a strong score. So what are they doing right? They have a decent current ratio, which indicates us they have enough assets on hand to cover those liabilities, which we like to see. Return on equity as a trend has been hovering around 21% on average. So the return on equity is decently high, which we like to see in a company. And if it's sitting on that kind of average, we want to see companies that have a stable return on equity. Also, over the last 5 years, their EPS has grown by 360%, which is ultimately great to see as an investor. If you've been holding on to this company, something you want to see, especially as revenues are going up. And couple that with, I'm going to just jump ahead for a quick second, with their share dilution. So I'll just jump ahead for a quick second, but what we like to see is these three categories: EPS growth, debt to equity, and share dilution be in the green. Share dilution means that they have been buying back shares, so decreasing the amount of shares outstanding, which is phenomenal. That we don't want companies diluting shareholders, buying back shares, or at the very least keeping the share count the same. Now, their debt to equity, which I skipped over, is also very important in my opinion, because that indicates to us how are they funding their operations, what is their financial leverage, and basically they're funding their the business through equity and not taking on debt. Couple that with the share dilution going down, that is a very sweet spot that we're currently in with Google. Now on the other side of the board here, we have our net income is up, free cash flow is up, return on invested capital sitting at a whopping 16%, along with our revenue growth up as well over the last 5 years. So Google as a business numerically is done phenomenally well. They're only getting docked in that one point, being the price to earnings ratio of 24.95, which honestly isn't so bad. Now, What does that mean for us investors looking to get in? Well, if we can ignore this price earnings ratio at being at a slight premium, everything shown here says that this company knows how to run itself properly. Now, granted, this is based off some past performance. Now, it doesn't mean that the past performance is indicative of future performance. So what does that mean for us? What we should be doing is figure out what should we be paying at a minimum based off of the worst case scenario of performance over the next, well, I'm going to go 10 years. So what I've done here, folks, is load up some numbers in the price analysis section here, which I'm going to explain to you in just a quick second. So 10 years of evaluation, I've inputted some numbers based off of what I think the company will grow by over the next 10 years. So in the last year, revenues were grown by 9%. I'm taking a conservative approach and going 3, 5, and 7 based off a conservative, moderate, and aggressive approach. And folks, if you're finding this video helpful, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. So what I've done here is take extreme conservative metrics in the revenue growth. I kept the profit margin and free cash flow margin the same because I don't think that's going to change too much going forward, along with a conservative price to free cash flow and PE ratio sitting below what we currently have at 24.15 for the price earnings, for the price to free cash flow, and 28.43 for the price earnings ratio. Put a desired return of 13%. I'm going to hit calculate, and what the software is going to do is going to crunch all of these numbers that I've inputted, and it's going to give us the current price or the average calculation of what we should be paying for this company today. We'll just give it a second here. Okay. So folks, based off of the software, the current price of this company is $136.80, and the average calculation comes out to be $89.24, with the aggressive average sitting at 117. Here's what I think, and here's what potentially what you might think. You might say, Leo, you're way too conservative for a company such as this. They have YouTube, they have Google, they have all their business model is phenomenal. They can't be touched. Sure, maybe that is the case, but you want to also keep in mind the market cap of this business is the 1.72, oh my god, I can't speak today, $1.72 trillion company. So what does that indicate to us, folks? It's an extremely large company, and the larger the company grows, the slower it's going to grow as well. The growth rate will eventually slow down. So I can't expect it to have high revenue growth numbers considering where it is in its life. So to me personally, the 3 to 5% revenue growth numbers makes the most amount of sense. If you believe it's somewhere in this metric here, then that to me is a little bit aggressive, because just based off the size of the business alone. Now, what do I think? I think obviously the cheaper you can get this business for, you're laughing. You know, essentially, if it gets down to this $89 price tag, you're laughing because you're getting this business at an extremely cheap price. Now, if you're below this 117 average and you think, hey, you know what, Leo, I think it might be between $86 and 117, so let's say call it $95 or $97, something like that, then you know, you're going to have a great time too. The key thing that I'm trying to teach you guys on this channel is ultimately we want to find great stocks, which based off this, it's shown that this is a competent business. It knows how to run itself. The numbers make a lot of sense. However, we don't want to overpay for those great companies. So this is why I like to use the price analysis section of the software to try to indicate, okay, what should we be paying? So my personal opinion, yes, around the $90 price range, you're getting a phenomenal deal for this company. If by chance it crashes overnight and goes down to $63, I'm picking it up like hand over fist. Now, the software I'm using, if you enjoyed my video and you enjoyed me using the software, you can follow the link in the description box below. 7-day free trial. It costs the same amount as your Netflix subscription. Only difference is this could potentially make you a lot of money, while your Netflix subscription will just waste your time. Now, along with the stock specs page that I showed you here, we also have the income statements, cash flow statements, and balance sheets, along with a charts section that allows you to chart out every single metric that we've talked about today. in an easy to read fashion, and our financial data goes back 10 years. This is a phenomenal piece of software, I believe, to help figure out what companies are doing right and what they're doing wrong. And look, it's not even 10 minutes into this video and you know exactly where Google stands numerically and what you should be paying for it. So why not? And this is just the tip of the iceberg, folks. So why not get something that's going to help you grow your wealth? Anyways, folks, that's the video. Thank you so much for watching. I will catch you in the next one.